of Niles Investment Management. Dan, great to have you on, especially just as we come from that court case, plus this big announcement with the NVIDIA chips. Give us a sense of where you see Meta as a play at all in people's portfolios.
Well, I mean, there's two ways you can look at it. I think for me, when I'm trying to figure out which companies in the AI ecosystem are the best, there's a lot of different metrics you can judge it on. And with Meta, they fall down on some and do well on others. The one that they do really well on is who uses AI well to drive engagement to the platform, helps monetize the platform, and then can have that flow through to the bottom line. And that's why when Meta reported, you saw the stock have a big move, because even though they had a massive capex number, they put up huge revenues, great margins, that flowed through to EPS, and the forward numbers went up, and that's what people wanted to see. And so that's where they do well. Where it falls short is they don't have a leading LLM or model like a Gemini or a Grok or a ChatGPT, and they don't have a public cloud yet. They're trying to build one, much like what Google Cloud has, or Microsoft with Azure, or Amazon with Amazon Web Services. And that's why you've seen the stock come back in since they reported those great numbers, because people go, wow, you're going from generating cash to now burning cash, because you've got to go in there and compete with these monsters that already have big cloud businesses.
Yeah, it's in the red year to date. It's not the most exciting name. What is more exciting for you? What is a better name for a portfolio right now from where you stand?
Well, I think if you look at what companies reported and guided to before Q4 started, people were thinking hyperscaler capex this year for AI would be up about 25 to 30%. When now, after all these companies have reported over the last 45 days or so, that number's moved from 25 to 30% growth to closer to 60%. So there's really only two great ways to play that. If you're going to buy a GPU to run AI, that's NVIDIA. And if you're going to have a custom chip, that's Broadcom. And if you look at NVIDIA, it trades at about 25 times earnings. The S&P trades at 23. So you're not paying that much of a premium for this company. And so I think if you own both of those names, you're pretty much covered.
So you're comfortable now with that valuation at NVIDIA. It has come down. It's certainly, you're not buying it at the high, which is always nice. Try and tell viewers, don't buy at the high.
Yeah, I mean, the bottom line is, do you think there's upside to numbers? And to me, it's pretty simple. Their customers, we thought 45 days ago, were going to increase their spending by maybe 25 to 30%. Now it's closer to 60. That's pretty much all I need to know.
Let's talk about the software picture. We saw a pretty bad takedown of software names over the past couple of weeks. I know you believe there's some real gems in there. Which ones are now at a price you really like?
Well, okay, so let's step back for a second. The whole software space is still going to have to go through some reassessment, because think about it this way. In 2011, Mark Andreessen put out a piece that's saying software is eating the world. That's 2011. You're not going to go ahead now in 5 months and re-rate the whole space when you spent 14 years building this up. So there's a lot of companies that are going to get wrecked. The spaces where I think ultimately that will do well is in database, because the one area you can't afford to get screwed up is where your customer data sits. The second one is obviously in security, because you can't get hacked, and there's also a compliance component associated with that. So those are the areas that I'm looking at saying, okay, I'm not sure if we've hit the bottom yet. We might be getting close to a short-term bounce, because today you're seeing one of those security names, Palo Alto. We don't have a position in it right now, but they're getting hit off of their numbers. The numbers weren't that bad, but it shows you that valuations in software, unlike with an NVIDIA, are still very high, and investors still aren't comfortable.
Well, but before the software sell-off, Palo Alto Networks, great company, one of the best in class. I mean, 1 month down 18%, 1 year down more than 26%, and yet you're ready to maybe dip in at a certain point.
Yeah, but remember, they're trading at 40 times. Why would I buy that if I can buy NVIDIA 24? I mean, there's a risk reward that people have forgotten about because over the last 3 years plus, it's been easy money all the way. You had Fed rate cuts, and then on top of that, you had the AI supercharging the moves in some of these names. So for me, I always look at risk versus reward. And so if I can buy one group of companies, especially an NVIDIA or a Broadcom, which are much cheaper, and I know their customers are all taking up demand. At the same time, you look at Palo Alto and go, yes, security obviously be very important going forward, but you have to remember the reason these stocks are getting hit is if AI can do things and replace 10 people, then you need less software licenses, and that includes security to some degree. And so that's why with software, it's a lot more complicated, and everything will continue to get, hit for a while until you revalue to some valuation level that people go, okay, this makes a lot more sense. And that's why you're still seeing stocks like Palo Alto, which I think will be actually one of these names that does very, very well when we kind of get to a new valuation floor. But in the near term, you're going to have to reset some of these multiples because why would I pay 40 times for something growing at 20% if with NVIDIA, I can pay 24 times for something growing at over 50%, right? The risk reward is very different.
Dan, we watch your notes, we watch your picks, and we thank you for coming on to share them with our viewers. Good to see you.
Thank you.